Okay, I'm really grateful to Professor Danoon for inviting me to this conference and also having the opportunity to hear so many interesting opinions today or comments today about the recent events in China. He asked me to look at the shadow banking. I said, what am I going to say about shadow banking? I'm just a lousy banker, or was anyway. What am I going to say about it? If I was going to have put together a presentation, it'd be very similar to Cindy's, but nowhere near as good. So, but he said, no, it's got to be from a banker's perspective. So this is my take on shadow banking, after having spent 20 years as a banker in Beijing. I want to say that as Cindy has used a banking definition from the Financial Stability Board, so have I used the same thing. My view on shadow banking in China is with certain caveats, it's a good thing, at least for foreign bankers in China potentially. The reason I say that is because it's so exceptionally difficult to compete in China if you're a foreign financial institution. Foreign financial institutions, or foreigners, hold less than 2% of Chinese financial assets. A few years back, I asked Zhou Xiaochuan, I said, looking ahead 5 years, Dr. Zhou, what do you think foreign banks are going to do in China? He said, well, I don't think anybody's thought about this. Maybe they'll have maybe 2% of financial assets. So it was a good time to retire. But thinking about this, though, the only way that a foreign institution or financial institution in China that can really compete, make profit, and be involved in the economy is through innovation. And the only time you can really have the ability to innovate is when the policy environment permits you to do so. So the emergence of these shadow banking products in 2007 were really the first indication, although they emerged for reasons that had nothing to do, I don't think, with interest rate reform. But nonetheless, they began to give foreign banks, the opportunity to think about maybe making a contribution and building something out in China that could make money, but also help push Chinese financial reform forward. The problem with the financial markets in China, you've heard a lot about it today, but I'll say it again, it's a capital pricing model. The rise of the shadow banking products gives a possibility of perhaps repricing that by repricing the cost of capital. If you look at the financial environment in China, you'll see that the big 5 or 6 banking institutions, including the postal savings banks, really dominate all the sources of funding. There may not be bank deposit insurance, but everybody understands bank risk. So most of the deposits are in these big banks. At the same time, they're also the largest investors in the nascent debt capital markets, as well as providers of corporate loans. The corporate bonds are simply a subset of that. So capital is mispriced. If you go and look at these, I want to go back to that later, I guess. Here's the bond market. It looks great. It must be really going well. But here's the government bond market. There's 150 trades, 160 trades a day on average. This is against 500,000 trades in New York City every day. Maybe 200 billion bucks versus $1 trillion. And these trades are all among the primary underwriting group. The reason they don't trade is because they're priced under what a real capital price ought to be. Here is the official government bond yield curve. You can see where the spots have just sort of been filled in. There is no yield curve. This is the yield curve. Now, somebody alluded to an announcement that was made today about certificates of deposit that were perhaps going to be a large-size certificates of deposit that banks were potentially going to be able to issue across the country. This could possibly be a breakthrough in changing the influence of the one-year bank deposit rate and lending rates, but that still has not happened. You also have a very plain vanilla investor universe, as you've seen before, but this gives you the whole thing. You don't have products that fit the needs of pension funds, of insurance companies, and certainly don't have products that fit the needs of individuals. That's why you have so much speculation in the real estate markets and the stock markets. There's nowhere else to put your money. If you're an individual, you save your money, there's nowhere else to really put it that's safe and that gives you an inflation-adjusted return. So this is where a foreign bank, I'm a little bit reluctant to say this given the past several years' history of the United States after 2008, but this is really where foreign banks have some ability to factor in things like liquidity, market risk, interest rate risk, and all this, and work to produce a product that would suit the Chinese market and different varieties of Chinese investors. I've got a little bunch of stuff in here, but I'll jump through that. You can look at it online if you like. The way products get disseminated in China and the market is when a bank, or any bank, but when a foreign bank comes up with a new product, it has to be approved by the banking regulator. And the documents you submit to the banking regulator are basically a blueprint of the product from the back office functions all the way to how you price it. So ultimately, all of that information gets out to the Chinese financial universe, and you have to move on. If you cannot innovate there, you cannot win. So ultimately, somebody mentioned today that Deng Xiaoping's major comment or contribution to how we should move forward is by crossing a river stone by stone. This is how you can move financial reform forward stone by stone, because you must have concrete evidence of how you do things. Then you can feel comfortable. I think the major risk that China faces today is that its leadership does not understand what financial reform really means, because its regulators do not understand what financial reform means, because it really hasn't begun to happen yet. Those are my comments. Thank you.
Thank you very much, Carl.